This is the best jobs report in Trump's second administration. And we are so excited about this, and the jobs reports continue to demolish expectations. We just have to emphasize to stop doubting President Trump's economy. And the experts continue to do that. And every single month, President Trump proves them wrong by having higher job numbers, this time doubling the month before, tripling.
The U.S. economy delivering a major surprise, and it is a lot stronger than expected. Welcome to the Big Money Show. I'm Taylor Riggs, along with my co-host, Dagan McDowell, Brian Brenberg, Jackie DeAngelis. And with us for the entire hour, Kaltbaum Capital Management President Gary Kaltbaum. Great to have you. So employers adding 172,000 jobs in May. That is more than double the expectations, while the unemployment held steady at 4.3%. This is the first jobs report with Kevin Warsh as Fed chairman, and markets right now pricing in a hike by the end of this year. Meanwhile, take a look at oil. Oil investors, oil down on the day because investors are growing optimistic that Washington and Tehran can reach a deal. But President Trump says all options remain on the table.
As far as Iran's concerned, you're going to find out what the deal is. But the main parts of the deal is they can't have a nuclear weapon. I think we're doing very well, but we're going to see if we're going to win one way or the other. We're going to win on paper, or we're going to win military. One way or the other. It's going to be militarily or on paper.
All right, Gary, I want to focus on the jobs report because clearly this is a market that was, I think, a little bit caught off guard by it, and definitely caught off guard by at least one house that I read that says we're officially changing our call to Fed rate hikes this year from cuts. You look at the revisions from March and April showing 93,000 more jobs than originally created. What are your thoughts?
I thought the job market was okay for a while. Last month better. I'm a big believer in jobs that the trend is your friend and the trend is turning up, simple as that. And let's hope it continues. I will be happy when I see 250 a month. That will be real good. Now, everybody's talking about the market dropping today. I got two things for you. Number one, 80% of the market at least has been technology stocks on this move up. Number two, it's getting a big haircut today because of how big of a move up it is, and that's what you're seeing right now. The other part of that equation is big part of the market, and the president needs to know, is easy money versus tighter money. That's what drives markets. We've had easy money. The money supply has been skyrocketing. This will tend to slow that down. We'll get tighter. The Fed doesn't need to raise rates. We're at 4.5 on the 10-year. The Fed funds is at 3.5. That's a good spot. Growth does not mean inflation. I'm amazed that so many people say that. If the Fed stood where it is, just fine and dandy as far as the market, corrections happen. It's normal. Right. And if you look at the chart of the semiconductors and some of the AI, vertical is the word that comes to mind. So this type of pullback is going to be harsh and probably has got some more to go.
I'll reprise my chart for you maybe later this hour. Instead of the Mag 7, we did the Parabolic 7 just for you. It was really right. The memory chip stocks like SanDisk and Micron that are up 300% year to date. So it's okay if they come down a little bit. But Jackie, when we talk about the trend, including monthly averages with just the private sector, the 3-month average is 166,000 versus a 6-month average of 87 and a 12-month average of 56. So he's right that actually jobs are accelerating and improving on some of these shorter term averages.
Yes, and this is a case where good news is not great news for the market. This is how the market is interpreting it because it's thinking about what's going to happen with rates. What does the Fed look at? The Fed looks at the labor market, which is strong by all accounts, and also at inflation, which we've got an issue because of oil prices. And so there makes no case right now, and I don't think you're going to see any truth social from the president to try to pressure Kevin Warsh in any way to cut rates. But I think that he will stay put. And the truth of the matter is you want to see a strong job market. You want to see the consumer out there. You know, somebody was challenging me on some comments that I made about the Trump economy yesterday and saying, where do you see that the consumer is strong? Where I see the consumer is strong is not necessarily from those sentiment surveys, because I don't always trust them. It depends on the sample, who they're talking to, how they felt that day. I see the consumer being strong because as long as people are employed, then they're getting a paycheck. They're out there spending money, even if it's just buying necessities. And corporate earnings and profits reflect the fact that the consumer is out there as well. And so these are all important fundamental building blocks for when the war in Iran is over finally and oil prices do come down. You want to see a strong economy that is ready to rip. And I've said that for quite some time. The market today selling off in tech makes sense because technology companies and rates are closely tied together. When rates are lower, there's more money out there. There's more that companies can do. And so I'm not surprised also after the run in these technology stocks, to your point, Gary, that investors are selling off a little bit today. I don't personally think this is anything to worry about.
Dagan, sort of on the rates perspective of all of this, I think we quoted Greenspan, who in 1996 said irrational exuberance, but took 2.5 to 3 years in 1999 before the bubble popped. So the market can stay irrational longer than you can stay solvent if you try to short this market. So on that note, if you're looking at a Fed that is at least not cutting, maybe stable, and I guess the market trying to say that there's a high, Kevin Warsh may or may not actually do that, but a 2-year up 11 basis points up the day to a 4.16, and a 10-year up 7 basis points on the day to a 4.54. Your thoughts?
Well, you don't need to raise interest rates if you stop the balance sheet expansion. So the balance sheet has been growing since early December by $176 billion. It doesn't sound like a lot, but Gary mentioned the money supply has been growing, and that is showing up in the growth of commercial deposits, a good proxy for M2, and that is purely because of the expansion of the balance sheet. So all you got to do is stop growing the balance sheet, and if you want to remove some of the stimulus in the system, you wouldn't need to hike interest rates. But that being said, interest rates, Fed funds rate is lower than the rate of inflation. We get CPI next week, which I think is supposed to be north of 4. It's supposed to be 4.2. That being said, you brought up Alan Greenspan. So Alan Greenspan talked about irrational exuberance, and that, his prognostication, nothing was really happening in the market. So what did he do leading the Fed? Well, they popped that bubble. They made doggone sure that the air came out of it toot sweet in 1990.
I'm looking up toot sweet. That's like the third time I've heard that term.
I just use it all the time.
Toot sweet.
It means
right
bing,
away.
bang, boom, right now, immediately.
Right away, okay.
So in 99, Greenspan and co. started raising interest rates despite the fact that inflation had ticked up a little bit to like 2%, 2.1%, and then it went to 2.3%. In 99, they took the Fed funds rate by the end of the year to 5.5%. So inflation was less than 3, and the Fed funds rate was north of 5. Oh, but they kept going. Even after, very clearly, the market had started collapsing, which was March of 2000. The Fed raised rates to 6.5% by May of 2000 on about 3.5% inflation. One thing that we know now, and they did the same damn thing that caused the housing collapse, now we know that you don't need to tackle inflation in such a serious way because there are calamitous effects when you do. You don't need to prick the bubbles. You can let it ride, and that actually helps them inflate away the debt. If you can borrow less than the inflation rate. One thing about the jobs report, I think it's just because we've, in 2 years, and Chris Lowe wrote about this, we've become so used to kind of abysmal job growth that 172 and a 3-month average of 188 is just not that great. It's okay. The aggregate hours worked was up just 0.1%, and that's, in Chris's words, sobering, and wage growth is still not even keeping up with inflation. So we have a ways to go here. Average hourly earnings only grew by 3.4%, when next week inflation will be growing north of 4%.
Brian, I want to come to you on wage growth. There were some, I think, some positive signs maybe out in the future that wages might start to keep up with inflation. Dagan's right that right now real wages are flat to negative.
Yeah.
But here's the commentary that I read. You are getting a rise in job vacancies relative to unemployment. You have high levels of corporate profits. So maybe it seems like wage increases could start to pick up in the months ahead, which is good because you want the wage increases to rise with inflation. I guess the other good news is this isn't wages are flat or negative. It's just the inflation problem. Wages are still growing, just not as fast.
Yeah, I mean,
Your
the wage
thoughts?
growth is okay. It's just you got prices going up because of oil and gas. So if you reverse that, then I think you got okay wages. I would say this was a pretty toot sweet report. I mean, I
That's
know
not how you use it.
I know, but I'm like adapting it because I just like saying toot a lot.
Okay.
Gary,
You know what it means.
It did right away.
Yes.
Yes, I looked it up on this
No.
active computer.
Toot as a verb. Look that up. Go ahead.
Toot your own horn.
No, it means to pass gas.
Oh, is
I knew
that
that was
what it means? Gary, I think 250 is too high. In a
What?
in a world, look, in a world where you don't.
300, 400,000, that would be fantastic.
Gary, you're stuck in Biden, everybody coming over the borderland. We're not doing that anymore.
Why can't we have Americans?
I'm not saying
getting
we can't, but
300,000,
I'm
350,
saying
or immigrants coming in.
In this
300,
world where
350.
we're not letting millions of people over the border, you don't have to grow at 250 to have a good number.
Really?
Heck yeah! What are you talking about? I
don't think higher the number, the better?
No, that's not what I'm saying. Higher's great. I'm just saying you don't have. 250 isn't the sign of strength in a world where you don't have people pouring over the border. I think 170 is a huge strength number. Now you could want more. I'm just saying in this world, this is a pretty dang good number. I do have one problem with it. There's too many government jobs in this. 55,000 government jobs.
Well,
Yeah, but did you
government's
see
a blob.
leisure and hospitality?
Leisure and hospitality were
Bars
good.
and restaurants are hiring. It's incredible.
I don't want to do irrational exuberance. Even my pessimist friends were sending me messages this morning saying this is the best report I've seen in a while, and I agree.
Because
with
it
that.
is.
It is, and like you said, the trend is your friend. My point is, I think there's a fair bit of strength at the bottom of this economy, underlying this economy, that's being masked right now by the inflation problem, by the oil and gas problem. You know, we were talking about, gosh, I think jobs are going to slow down. They're not slowing down right now. So that doesn't mean we don't have issues. I want to see the wage growth outpace inflation. But this is a pretty dang good report, and I don't think we should downplay that.
The wage growth was outpacing inflation before the oil price spiked. So if the oil price spike goes away, which the market is assuming that it will, and we're assuming that it will, then everything should normalize again, and you do want to see them adding jobs in this way. So that's why, I'm not concerned about this.
It's
but,
good
but it takes a person to not be too concerned about the conflict in the Middle East. I know that number next week's not going to look good. I'm ready for it. I'm braced for it. But I'm assuming that it's going to be temporary.